Craig Ferguson. Craig is Director at Antipodean Capital Management. First of all, Craig, let's just, these are risky assets. What is not risky at the moment, apart from cash?
Well, look, I mean, I think, even the safe havens that we'd become accustomed to over the course of the last couple of months of rushing to at times like these, the things like the franc, the Japanese yen and gold, they've all experienced significant weakness over the course of the last couple of months, and really that's only left the US dollar and Treasuries yet again as the normal assets of choice. Even if you look at gold today, yesterday we got up towards 1675. Today we opened under 1600. So the position liquidation just isn't over there. So the longs are still struggling to get out in gold. So there's really very few choices in terms of safe havens apart from the dollar and Treasury assets.
Well, I was talking to somebody last week in the middle of the sell-off, and he was referring to this not being capitulation, this was actually liquidation. You just used that word as well. How much further do we have to go down?
Oh, look, I think on major markets, we'll probably see a move to next support, which is roughly around 10 to 15% below current levels. So S&P around 1150 says it probably gets to 1010, which is the June 2010 low. Similarly, if you look at some other currency markets which class as risky assets, the Aussie currently around 97.5, probably needs to get somewhere closer to around 92. The New Zealand dollar somewhere to around 72. Oil probably has to get under 75 towards that 67 to 70 zone. So they can still fall quite away from here. I think the interesting thing though, Rish, is that yes, it is position liquidation, long liquidation, but what is going to drive these markets and determine whether they're really in a sustained bear market, one that's going to last another year or 6 months, is whether we actually get into recession, whether we actually get a earnings per share recession and an earnings per share downgrade cycle, and whether the bulk commodities like iron ore and coal start to fall significantly, 25–30%. We don't have either of those, any of those three factors kicking into play at the moment. So at the moment, it's actually, despite equity markets have fallen 20% from their highs, we really haven't reached the down point in terms of those three key variables in a similar way as we did in 2008. So depending on your view, that's either a scary thing or a good thing if you're a bear or a bull.
Craig, well, you say that those things have not been factored in. So what is being priced in right now? I mean, we've got all this lack of clarity when it comes to Greece still. We need something there, don't we, for sure?
Oh, definitely. The problem is, though, that Greece, an agreement on Greece is not going to be a good one. If you look at what happened over the weekend, we had the expansion and the leverage up of the EFSF mechanism, which the G20 and Geithner favoured, being popped on the head by the Germans. We had the European Investment Bank potentially creating a sieve, which would actually fund new bond purchases and bank recapitalisations. That was popped on the head. And the only other thing that came out over the weekend was that Greece's debt would probably require a 50% haircut instead of the 21% haircut that we had in the July 21 agreement. So the only thing that came out of that was actually one negative, and the two positives have since been discounted. So really we're not going to get a situation where Europe stabilises until the banks are completely recapitalised, like a TARP situation in the US, and where the sovereigns are either actually cut off at the knees, Greece is actually thrown out, or until we get a situation where a much larger recapitalisation scenario is offered in terms of the sovereigns, and neither do we have at the moment. So it's a real problem, Rishaad, in terms of Europe. And at the moment, what's priced, getting back to your original question, really just a normal growth slowdown and US GDP growth of 1 to 2%. Now, if you think that that's what we're going to have, then you'd be buying risky assets here. I actually tend to think we're going to get a double-dip recession and more contagion. So, it's a real problem going forward, because what's priced is not a double-dip recession at this point.
Craig, great to see you as ever. Craig Ferguson from Antipodean Capital joining us there from Melbourne.